Let me tell you something that most financial commentators won't say on camera. Gold is not a relic. Gold is not a boomer asset. Gold is not a boomer asset. Gold is not something you buy because you're afraid. Gold is something you buy because you're paying attention. And right now, the people who are paying attention are loading up on it. I've been in finance for over 4 decades. I've watched markets collapse, recover, collapse again. I've seen currencies destroyed by governments who couldn't stop spending. And every single time, gold did exactly what it was supposed to do. It held. And what's coming next is going to make everything we've seen before look like a warm-up. Before I go any further, I want to ask you something directly. Do you currently own any gold? Physical gold, ETFs, mining stocks, anything? Drop your answer in the comments right now. Because what I'm about to share changes depending on where you're starting from, and I genuinely want to know where my audience stands. This isn't a poll for show. Your answer will shape how seriously you take the next 10 minutes of your life. Now, let's talk about what's actually happening in the world economy, because there is a very specific event unfolding right now that most retail investors are completely ignoring. And that event, that single macro shift, is going to be the catalyst that pushes gold to levels that will make today's prices look like a bargain bin clearance sale. Here's what I know about money. Real money. The kind that survives wars, collapses, regime changes, and currency crises. It has 3 properties. It stores value, it's recognized globally, and governments can't print more of it. Gold checks every single one of those boxes. The US dollar, it checks 0. And before anyone in the comments starts defending fiat currency, let me be very clear. I'm not anti-dollar. I use dollars every day. But I'm also not naive about what decades of deficit spending, money printing, and debt accumulation eventually produce. History doesn't lie. Politicians do. History doesn't lie. Politicians do. The United States is currently sitting on over $34 trillion in national debt. $34 trillion. That number is so large that most people's brains simply refuse to process it. It's not 34 billion, which would already be staggering. It's 34 trillion, and it's growing by roughly 1 trillion every 100 days. Every 100 days. That's not a fiscal policy. That's a slow-motion catastrophe. And the people running the numbers behind closed doors, the sovereign wealth funds, the central banks, the institutional allocators, they see it too. And they are quietly, methodically, and deliberately moving into gold. Central banks globally purchased over 1,000 tons of gold in 2022. Then they did it again in 2023, then again in 2023, then again in 2024, 3 consecutive years of record or near record central bank gold buying. These are not emotional investors. These are not retail traders watching YouTube videos at midnight. These are the most sophisticated, data-driven institutions on the planet, and they are choosing gold. That should tell you everything. Now here's the psychological piece that most people miss, and I find this fascinating from a behavioral finance standpoint. The average investor waits for permission. They wait for CNBC to validate the trade. They wait for their neighbor to mention it at a dinner party. They wait for gold to already be at $4,000 before they start paying attention. And then they buy at the top and wonder why they keep losing. That is not investing. That is emotional reaction dressed up as a strategy. The wealthy think differently, not because they're smarter, not because they have access to secret information, but because they've trained themselves to act on leading indicators rather than lagging ones. And right now, every leading indicator in the macro environment is pointing in the same direction. Geopolitical fragmentation, de-dollarization, sovereign debt stress, persistent inflation. These aren't talking points. These are structural realities that don't resolve in a quarter or two. They play out over years. And gold is the asset that performs during exactly this kind of prolonged uncertainty. Let's talk about the specific event, the one I mentioned at the top, because this is where it gets real. The BRICS nations, Brazil, Russia, India, China, South Africa, and now a growing list of additional countries are actively constructing an alternative financial architecture that is designed to reduce dependence on the U.S. dollar and international trade. This is not a conspiracy theory. This is openly documented geopolitical strategy. Russia and China have been settling energy trades in non-dollar currencies. Saudi Arabia has opened conversations about pricing oil in yuan. Central banks that historically held reserves in dollars are diversifying. And what are they diversifying into? Gold. when the world's largest energy producers, the world's second largest economy, and a coalition of nations representing nearly half of global GDP start building a system that doesn't depend on your currency. That is a fundamental shift in the monetary order. It doesn't happen overnight, but it happens. And when it does, demand for dollars softens. And when demand for dollars softens, gold, priced in dollars, goes up. This is not speculation. This is arithmetic. I want to contrast two people for a second. Call them person A and person B. Person A hears all of this, nods, finds it interesting, and goes back to scrolling. Maybe they have some money sitting in a savings account, earning 3%, while inflation quietly erodes its purchasing power. They feel financially responsible because they're not gambling on risky assets. They're being safe. But safety is an illusion when the unit of measurement itself is losing value. Person B hears this, does their own research, and allocates 5 to 10% of their portfolio to gold. Not because they're panicking, not because they're a doomsday prepper, but because they understand that diversification means owning things that don't all fail at the same time. Person B sleeps well, not because everything is fine, because nothing is ever entirely fine, but because they've built a portfolio that can absorb what's coming. Which person are you right now? And which person do you want to be? Here's something I tell entrepreneurs and investors consistently. The best trades are the ones that feel boring when you make them and look obvious in hindsight. Nobody brags about buying gold at $1,200 an ounce back in 2018, but they should, because it's over $2,000 now. And the people who said it was a boring hedge are quietly very grateful they made that boring decision. The next 5 years are going to produce a new generation of people who wish they'd made a boring decision today. Let's talk about how to actually position for this, because I'm not in the business of generating fear without providing a framework. That's what bad financial media does. I prefer to give you something actionable. First, physical gold, bullion, coins. There is a psychological and financial value in owning something you can hold. It cannot be hacked. It cannot be frozen. It cannot be diluted. In a world of counterparty risk, physical gold has no counterparty. If the system around it fails, gold still functions. That is not a small thing. Second, gold ETFs. If you want liquidity, exposure without storage costs, and the ability to move in and out of a position efficiently, ETFs like GLD or IAU give you that. I hold positions like this as part of a broader allocation. They're not a replacement for physical, but they serve a different purpose in a portfolio. Third, gold royalty and streaming companies. This is where I personally find some of the most interesting risk-adjusted exposure. These companies don't mine gold themselves. They finance miners in exchange for the right to buy gold at a fixed price in the future. When gold prices rise, their margins expand dramatically. They're leveraged to the upside but insulated from the operational chaos that can destroy individual mining stocks. Companies in this space have historically outperformed straight gold exposure during bull markets. That's not guaranteed going forward, but the structure of the business model is sound. And this is important. I am not your financial advisor. I'm not licensed to give you personalized advice. Everything I share is my perspective based on my own analysis and experience. You should absolutely consult a professional before making any investment decision. That's not a legal disclaimer to blow past. That's genuinely good advice. Know your own financial situation before you make a move. But here's what I will say with full conviction. The macro case for gold right now is as strong as I've seen it in my career. And I've been doing this for a long time. The combination of sovereign debt pressure, de-dollarization momentum, central bank accumulation, and geopolitical fracture lines is not temporary noise. This is structural, and structural changes create structural investment opportunities. There's a mindset shift that separates people who build lasting wealth from people who always seem to miss the move. It's not intelligence, it's not luck, it's time horizon. The average investor thinks in days, weeks, maybe quarters. They check their portfolio constantly, react to headlines, chase what's already moved. The wealth-building investor thinks in years and decades. They position early, hold with conviction, and ignore the noise that sends everyone else into a panic spiral. Gold is not a trade. It is a position. It is a statement about the world you're operating in and how seriously you take the preservation of your capital. And right now, the world is giving you very clear signals about where things are heading. The question is whether you're listening or waiting for someone to give you permission to act. I've made a lot of money in my career by buying things that were unpopular and holding them until the world caught up to what I already understood. I've also lost money, significant money, by ignoring macro signals because they didn't fit the narrative I was comfortable with. Experience is an expensive teacher. I'm offering you some of that education for free. The event that's going to push gold to new highs isn't a single moment. It's a slow accumulation of pressure, geopolitical, fiscal, monetary, that eventually reaches a tipping point. We may already be past that tipping point, or we may be 6 months away. But the direction is not ambiguous, and when that move happens, it will happen fast. Prices will gap. Retail investors will try to pile in, supply of physical gold will tighten, and the people who position themselves quietly and patiently before the crowd arrived will be the ones who benefit. That's how this works. It has always worked this way. The window to buy anything before the crowd is, by definition, short, because once the crowd arrives, you're no longer early. You're just another person chasing a move. So here's where I'm leaving you, not with fear, not with hype, with a simple question you should be asking yourself tonight. How exposed am I to an environment where the dollar weakens, inflation persists, and geopolitical instability becomes the norm rather than the exception? If your honest answer is not prepared at all, that's information, valuable information. And information without action is just entertainment. Act on it. Do your homework. Talk to your advisor. Build a position that gives you confidence regardless of what the market does in the next 90 days. And remember, the wealthy don't react to markets. They prepare for environments. There's a difference. Start learning that difference now. If this gave you something to think about, share it. If you disagree with me, tell me in the comments. I read them. And if you're already positioned in gold and feeling good about it, I want to hear that too. This conversation matters. Let's have it.